Can you talk about, I guess, your view of that, value and growth, and just any kind of meta thoughts on how you think about those two things and are they really different?
I think a lot of people's minds just go haywire when they start thinking about this value versus growth debate. It's this Charlie Munger quote, right? Or the Buffett quote, all sensible investing is value investing. You want to get more than you're paying for. And growth is an input. Growth is an input into the value of a company. I love growth, right? I'm a value investor. I'll say that. I'll admit that. Maybe it's been a dirty word over the last couple of years, but growth is an input into valuing a company. So are margins, so are returns on capital, so are a lot of other things. I talk about this idea of buying compounders priced like cigar butts, right? Like companies that can compound value, can grow organically, but they're priced for some reason like a cigar butt. And I think that in the case of Clarus at $4 a share after this broken deal, or Turning Point Brands kind of on the broken IPO. These are each examples where I was able to pick up compounders. And Zigzag, both of the core businesses with inside of Turning Point Brands, Zigzag and Stoker's, are growing double digits. These are 10% plus top line growth rates on top of the stability, expanding regionally, expanding markets. It's great. And same thing with Black Diamond Equipment. Climbing interest is on the rise. People are getting outdoors more. Climbing gyms and indoor climbing are becoming more popular. Climbing was added to the Olympics for the first time. I think it was meant to be last year, and now we'll see if it happens this summer in Tokyo. But for the first time ever, climbing was going to be in the Olympics. And so there's this secular growth trend dating back 50 years. Black Diamond has grown at a 10% CAGR for 50 years. You know, it's priced like it was going out of business or something. And so growth is great. I just have a hard time paying some of the prices that some companies that are perceived to have high growth trade for in the market. So right now there's fantastic business models, software as a service, asset light, high growth, but they trade for 10 to 40 times revenues, 10 to 40 times sales. And so I've just had a harder time underwriting the amount of years into the future that you have to underwrite to justify those prices. You might have to say, like, this company can grow 30% plus for the next 15 years to justify this price. Whereas I like having to say, this company just doesn't have to go out of business to justify this price. But oh, by the way, it's grown 10% for 50 years and it's a great brand, well recognized, right? Like, it's just, that's the way my mind works. Other people have done really well underwriting higher growth companies at higher multiples. I've done well underwriting solid, stable businesses with growth, with good capital allocation at very low prices.
I'm so glad you shared that Warren Buffett quote, because it seems like the perfect encapsulation of, it seems like some people have an adverse reaction to growth when it talks about calling a company a growth company, but no investor would ever invest in a business if it had zero growth prospects. So it's like you want to have both of those there, and growth is just an input. I love that. I love that model.